If inflation doesn't break soon here, he's going to have to hit the brakes pretty hard. That will put us into a recession.
There will be an increase in rates, and central banks, have a narrow path to go down without harming the economy, but also neutralizing inflation, which is having a negative effect on consumers.
I think people who have benefited from this extreme low rate, high liquidity environment where all manner of growth have been rewarded. I think that's where the greatest correction will come.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Fed, day one, traders gear up for the central bank's biggest hike in 2 decades as the U.S. 10-year yield tops 3%, while the German equivalent hits 1% for the first time in 7 years. Energy agenda. The EU plans additional guidance on Putin's gas for rubles demand to lay out what companies can and cannot do under sanction rules. And Politico report reveals that the U.S. Supreme Court is poised to overturn the landmark Roe versus Wade decision protecting abortion rights. It could have a massive impact on U.S. politics and society. Now, good morning, everyone. First thing is first, let's check on the markets. Now, we're seeing a bond rout actually deepening, bonds around the world plummeting as investors brace for the biggest U.S. rate hike since 2000. If you look at European stocks, it's only the FTSE where we're still seeing a bit of pressure. Overall, though, we're seeing a nice little lift, getting some 0.6% across the board. If you look at U.S. futures, there's a bit of fluctuation. Banks being supported certainly by BNP Paribas results. That's because the volatility means that they made a bit more money when it comes to their trading units. But this is where the real action is. The German 10-year bond and the 10-year yield in the U.S. Again, the 10-year yield in the U.S. actually trading 3%. After hitting that milestone yesterday. It has huge implications for the whole read across, also among stocks. Australian bonds, also something that we need to watch out for. Still sliding, the currency jump after the nation's central bank increased borrowing costs by more than many had expected. So if we go to the central bank conundrum, we look at ECB and Bank of England. We do have the Bank of England on Thursday. The FTSE, you can see here in the UK, the only one that's down some 0.2%. Otherwise, for the moment, we have energy on the way up, and that is giving a lift to some of the commodity rich, including, for example, CAC 40. I'm not sure why the FTSE actually is down some 0.2%, but certainly something that we need to keep an eye on ahead of the Bank of England on Thursday. So let's get into some of the key market drivers with our markets editor, Christine Aquino. Christine, first of all, what lessons can the Fed actually glean from the RBA's experience in delivering this supersized rate hike?
Well, Francine, I think the RBA was really delivering a masterclass in the element of surprise here. This was something that traders and investors really did not expect. The fact that they were going with a bigger than expected rate hike, as well as forecasting potential future rate hikes, given that path of inflation that they flagged during the meeting. So this is quite a difference from what we've seen from the Fed, right? We've heard policymakers, Jay Powell himself, time and time again, flagging that potential for a 50 basis point rate hike this coming Wednesday. And so a lot of that potentially, arguably, is already priced in. I do wonder what sort of impact the Fed will have once we finally see that 50 basis point rate hike come into reality. And is there potential here for the ramp up in yields to stall? I know that we hit that key 3% level. Is there potential for yields to pull back, at least in the short term?
Yeah, and also, I stand corrected, the FTSE, of course, catching up because yesterday it was closed because of bank holiday, which explains that little bit of differential, Christine, between the FTSE down and everything else in Europe getting some 0.5%. So how does this all play into some of the yields and key thresholds for various markets? Is there a potential for sell the rumor, buy the fact after some of these rate decisions?
I think, Francine, there is very much potential for that, especially because, again, we've seen policymakers really telegraph this move. The Fed, in particular, really telegraphed this move that we are about to see. I think it would be a bigger surprise if they suddenly decided that 50 basis points was not on the table after all. And so, that would probably have more potential to cause disruption rather than a 50 basis point rate hike itself. And so I think, given the momentum that we've seen, today we're hitting those key levels on the 10-year Treasury yields, 10-year bond yields, 3-year Australian yields. I think there really is an argument here for a bit of that momentum to slow, especially once we get confirmation of those rate hikes later this week.
Christine, what can you tell us about some of the earnings? So depending on whether you have exposure to Russia's, such as BP, there's a clear divergence.
Absolutely, Francine. It turns out that Russia appears to be quite a key differentiator for this earnings season. Again, BNP benefiting from all that volatility that ensued from the Russia turmoil at the start of March, late February. But, you know, that was something that the bank really benefited from when it comes to those trading volumes. Then, of course, on the other hand, you had BP, which had to write down nearly $26 billion because of its exit from Russia. But it's still benefiting from the higher oil prices because, of course, we're still talking about this potential crunch in the energy supply as the Russia geopolitical tensions continue.
Christine, thank you so much. Our markets editor there, Christine Aquino. Now, Fed officials will meet later today with a decision on U.S. monetary policy coming tomorrow. Ahead of that, the sell-off in Treasuries boosted the yield on the benchmark 10-year note to 3% earlier today for the first time in more than 3 years. Well, top investors at the Milken Institute conference discussed rising inflation in the U.S.
If inflation doesn't break soon here, he's going to have to hit the brakes pretty hard. That will put us into a recession.
I think people who have benefited from this extreme low rate, high liquidity environment where all manner of growth have been rewarded, I think that's where the greatest correction will come.
It is simply unfeasible for economics or economies, for human beings and their livelihood and well-being to shut down the fossil fuel industry. And I think we're seeing this live in Europe with the Russian crisis.
If the inflation is transitory, if we are heading towards a 4% rate by the end of the year, he has a lot more room to maneuver rates in 2023.
Well, we're now joined by Henrik Johnson. He is co-head of capital markets at Deutsche Bank. Henrik, thanks so much for joining us. First of all, I mean, you have a unique insight into what clients think, on what they worry about. Are they worried that they don't have visibility going ahead because of inflation and monetary policy, or do they actually think a recession's coming?
I think, well, I speak to a lot of corporates especially, and I have to say, you know, the consensus is while earnings so far have been good, as you've reported, the outlook is pretty dire. And from an issuance perspective, what we're seeing is that investment grade issuers, who are obviously priced on spread, are issuing as much as they need and going ahead, and investors are receptive. But you know, other products which are more yield based are a bit tougher. Understandably.
So what are they worried about going ahead? Is it inflation? Is it a monetary policy mistake? Or is it actually a recession because of monetary policy?
I think people see a recession coming down the pipe. And you know, it's going to be a very difficult challenge for central banks to engineer the soft landing that they want. So, you know, while obviously we're hoping that the central banks manage to hike rates appropriately to cool the economy globally, there's some real downside risks, especially here in Europe from the Ukraine. So I'd say, you know, most people are pretty conservative.
I mean, this is a huge calibration, right? Do they worry that this will be a self-made recession, so that we hike too much, that actually the Fed, the Bank of England, the ECB look at inflation, freak out, they hike, and actually forget the economy?
Well, at the same time, you can't let inflation go out of control. So, you know, I don't envy them their jobs. But, you know, I think the sort of the rate of the hikes that are currently priced in, you know, accord with our view at DB. And, you know, I think the central banks are going to have to be reactive. You know, they're going to see what CPI does, you know, what stock markets do, and then they'll try to calibrate. But it's not going to be easy. I
mean, are your clients worried that they're reactive, where they should be ahead of the curve?
I mean, look, I think no one's really, no one has a crystal ball to try to forecast what the central banks do. But, you know, you are seeing companies gather liquidity to insulate themselves from a potential recession. You know, and there's a lot of hedging going on as well. There's FX volatility. So, you know, I think a recession certainly isn't a certainty, but you know, the risks of it have gone up a lot in the last 3 months, especially since the rise in energy prices because of the Russian invasion of the Ukraine.
Henrik, when you look at some of your clients, so I know you can't talk about them specifically, but is there a sector where they're feeling most pain compared to others? When you look at earnings, some of them, of course, are able to pass on some of the costs. They still have inventory that's quite low and high margins. Yeah.
I'd say, yeah, it's a mixed picture, and there's winners and losers in every sector. But I'd say in general, retail clients, you know, directly exposed to the consumer, you know, they're probably the ones that are focusing very much on cutting costs. And something that they're all doing, which is actually interesting, it hasn't been required for many years, is how do you get your organization to actually pass on price increases when no one's been in an inflationary environment? So even at sort of lower down in the organizations, in the sales teams, you have to tell them, no, you have to raise prices, and you have to raise prices again. And no one's had to do that for 10 years, and that's a challenge.
So the challenge is what, mismeasuring it or then selling it to the end consumer?
It's actually incentivizing the sales teams to push through against obviously some resistance from their customers. But if you don't get ahead of the inflation as an organization, then your margins are going to suffer, and your results will therefore be poor relative to your competitors. So it's almost a behavioral shift. It's the same in financial markets. Very few people have been in this kind of rising rate environment for the last 15 years. And so it's a challenge for investors as well. How do you trade a potential 150 basis point increase in the Fed fund rate? It's a big challenge.
Big challenge, and then of course you worry that if you increase your prices too much, then they change brands. Henrik, that's the conversation we'll have next. Henrik Johnson there, co-head of capital markets at Deutsche Bank. He stays with us. Coming up a little bit later this hour, we talk global supply chain disruptions with the Interos chief executive and founder, Jennifer Bisceglie, and the chief executive officer of Improbable, Herman Narula. You can join us. You can tell us about selling virtual land in the metaverse. Well, actually, you can ask me questions to ask them. That will make everyone smarter. Or don't. This is Bloomberg.
Wednesday, a Bloomberg exclusive. JPMorgan Chase Chairman and CEO Jamie Dimon speaks with Bloomberg's Francine Lacqua, live from the JPMorgan CEO Summit in London, only on Bloomberg TV and radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's focus on the trends within M&A and equity capital markets. By the beginning of April, at least 100 companies worldwide had delayed or pulled financial deals worth more than $45 billion. Now that was since Russia's invasion of Ukraine. The conflict has roiled funding markets, hurt investor appetite for risk, and increased uncertainty over growth, interest rate hikes, and supply chains. Well, we're back with Henrik Johnson. He is co-head of capital markets at Deutsche Bank. Henrik says he sees decent equity capital market performance in the second half of the year, despite the impact of Russia's war in Ukraine. Is it going to be, and we'll talk a little bit more about inflation because we're having a great conversation on inflation. How difficult is it for us as the sales force to realize that they need to pass on some of these increasing pressures? But overall, do you think there's pent-up demand of deals wanting to be made that were kind of stopped in the beginning of the year because of the war in Ukraine that will pick up at the end of the year?
Absolutely, and it's driven by the fact that there's a massive disconnect between private and public markets. So in the private markets, there's still plentiful liquidity, both in private equity and in the direct lending setup, and you haven't seen the adjustments of valuations there, but you have seen the adjustments obviously in public equity markets and debt markets. And so what we're working on, and our competitors are as well, is a lot of public to privates, as some of that private money looks at things that they haven't been able to afford before. And now valuations have come way down, and so opportunistically they're making some bids. And I think that's going to be really the driver of M&A in the next few quarters. I
mean, there's something incredible, and we have a chart illustrating the fact that 10-year yield actually touched 3% yesterday, or in the early hours of last night, like just a couple of hours ago. And I don't know whether that will be more symptomatic of a shift into some of these private markets, or how you see all of this cheap money out there changing hands over the next 12 months.
Well, the question I think for the alternative asset managers is, will they be able to fundraise at the same pace as they have when the risk-free rate is much higher? Because obviously a lot of their attractiveness of their product has been because it's been a way to generate returns for savers, insurance companies, and so on. I think they would argue that in treasuries, your real rate is still going to be negative. And so by investing in alternative assets, you actually lock in a sort of a positive net return. But I think time will tell, and some of the froth has come off the market for sure.
So how much time do you need to tell? Is it 6 months, or could this be a longer-term trend that would take 18 months? We're in the middle of a massive private equity fundraising cycle right now. Virtually every company is out there trying to raise a big fund. And the results will start dropping in the next few months, I'd say, before the summer to see, is it a 30 billion fund? Is it 25? Is it 20? That would be bad.
So that will be an immediate way to tell. And then also, is there going to be pressure on private marks to be adjusted down as well, which will make everyone a lot more risk averse?
Henrik, are SPACs still a thing? Because there's so many, of these special purpose vehicles that still need to find a target.
A lot of people ask that, and obviously SPAC issuance is definitely not a thing. But the SPACs that still exist, many of them, the clock is ticking on them finding a target. And actually, ironically, with the adjustments in public equity markets, they've suddenly become a lot more attractive, to investors because you're able to lock in a better valuation. So I wouldn't count out the SPAC M&A market just yet.
Okay, interesting. In what sector across the board, or is there a specific sector that you think will be?
It's quite tech heavy still. Yeah.
As always. It's always tech heavy, isn't it, Henrik? Thank you so much. Henrik Johnson, there, co-head of capital markets at Deutsche Bank. Now, coming up, we'll bring you some of our conversation with Santander Executive Chair Anna Botín. Don't miss that. This is Bloomberg.
Both Europe and the US had a big amount of savings accumulated. So the numbers are between 1 trillion in Europe to 2.5 trillion in the US. So the consumer is in a pretty good state for now. Obviously, they're beginning to suffer the increase in energy prices more in Europe. But we see still, if you compare year on year, the consumer is strong, including in the US, also in Europe. Where we see a bit of weakness is in the investment from corporates. So I think that's where we have not seen a pickup as we would expect. But we believe that should happen because there's a bigger demand to have that supply chain closer to home. Energy companies having to finance working capital, and that is also a bigger demand for credit. So I'd say consumer strong, no signs of weakness yet. On the corporate and commercial side, not as strong as we would like.
Well, that was Santander's Executive Chair Anna Botín speaking exclusively to Bloomberg's David Weston on how the consumer is holding up against a sky-high inflation. Now, BP has also expanded buybacks after exceptional trading performance. We've also been speaking with the Chief Executive, Bernard Looney.
The oil markets in many ways are a little bit more straightforward to resolve than the gas markets. The oil market's a much more global commodity, and a lot of those cargoes of oil provided seaborne cargoes, so to speak. So it's a slightly less challenging problem than natural gas, but it nonetheless presents challenges. What we've seen to date in the energy markets are about 1 million barrels a day of Russian crude off the market. That may double, Anna, this month when sanctions come truly into effect, and that's before the sanctions that we're talking about right now. We've got lowish stocks around the world. We've got lowish spare capacity around the world, and we have a lot of uncertainty in the market, quite frankly, whether it's with Iran, whether it's with Libya, whether it's with the global economy, whether it's with zero COVID in China, lots of uncertainty. But I think if you step back from it, you'd say all of these things lead to a lot of volatility, and we can expect that volatility to continue. And at the same time, I think we can expect prices to remain strong, I think, for quite some time.
Well, that was the BP Chief Executive Bernard Looney speaking with our Anna Edwards on the stock price, gaining some 3.2%. Now let's get straight to the Bloomberg First Word News. Here in London with me is Laura Wright. Hi, Laura.
Good morning, Francine. Politico reports the US Supreme Court is poised to strike down the landmark Roe v. Wade decision, which protects women's rights to abortion. Politico says it's seen a draft opinion written by Justice Samuel Alito, which has preliminary support from 4 other Republican-appointed justices. The 9-member court is scheduled to rule in the case by July. The European Union is to provide more detailed guidance in the coming days on what companies can and cannot do under EU sanctions rules to address Russia's demands to pay for gas in rubles. Energy ministers from the bloc met yesterday in Brussels to discuss the problem. Separately, Bloomberg has learned the EU plans to look to African nations for more liquefied natural gas to help replace Russian supplies. Hong Kong is bringing forward reopening plans as COVID infections drop. From this week, masks will no longer be required for exercising outdoors. The city will allow dine-in at restaurants until midnight later this month. New virus cases are back at February levels as health officials say the 5th wave of COVID is under control. Citigroup says its London trading desk was behind a flash crash in Europe yesterday. The brief blip sent shares across the continent tumbling after a sudden 8% decline in Swedish stocks. The US bank says one of its traders made an error when inputting a transaction, but it was corrected within minutes. Boris Johnson is to deliver a virtual address to Ukraine's parliament today, becoming the first world leader to do so. The UK Prime Minister will compare the Eastern European country's struggle to Britain's during World War II. In addition, his government has announced a new package of £300 million in military aid to Ukraine. Italy has raised its windfall tax on energy industry profits from 10% to 25%. That's as it approves a €14 billion package to shore up companies and consumers hit by surging costs. Rome has already taken significant steps to reduce its reliance on Russian gas supplies, which account for around 40% of gas imports. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Laura, thank you so much. Coming up, we talk China. This is Bloomberg. Fed, day one. Traders gear up for the central bank's biggest hike in 2 decades as the U.S. 10-year yield tops 3%. The German equivalent hits 1% for the first time in 7 years. Energy agenda. The EU plans additional guidance on Putin's gas for rubles demand to lay out what companies can and cannot do under sanction rules. And a political report reveals the U.S. Supreme Court may overturn the landmark Roe versus Wade decision protecting abortion rights. It could have a massive impact on U.S. politics and society. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first, let's check on the markets, and we're holding on to gains. If you look at U.S. futures, though, a bit more of fluctuation when it comes to gains and losses. Now, when you look at the European Stock 600, gaining some 0.7%, a lot of it is earnings. A lot of it is also this bond route deepening, rate hikes looming, and stocks, for the moment, holding on to some of those gains. Now, the U.S. 10-year yield trading near 3% after hitting that milestone on Monday, currently at 2.9927. Meanwhile, investors also betting that global bonds are still expensive and taking shelter in equities in today's trading session. Now, the global economy is currently suffering an unprecedented series of supply chain shocks. The pandemic, along with geopolitical tensions, and in particular, the war in Ukraine. They're placing further strain on the already fragile and very complex supply ecosystem that forms the backbone of world trade. Well, one company that seeks to manage risk and increase operational resilience in the supply chain realm is Interos, and we're joined by its chief executive and founder, Jennifer Bisceglie. Thank you so much, Jennifer, for joining us. First of all, talk to us a little bit about Interos. I mean, this is an amazing company. You track supply chain, so you can tell me, because of the war in Ukraine or because of COVID and the way that China is dealing with it, this many suppliers in the U.S. will be affected. How has the war in Ukraine changed the game for the next couple of months?
Well, thank you for having me. And I think the biggest thing to remember about what's happening with the war with Ukraine is simply the human toll. It's profound. And millions of people have been impacted, from refugees to homebound workers, which has forever shifted and expanded the supply chain. And if you couple that with the fact that right now in the court of public opinion, companies are literally being judged by the health of their supply chain, having the right product to the right place at the right time for the right price. You know, most companies and most supply chains simply were not built for the kind of volatility that they're experiencing right now.
Jennifer, why do you need AI to try and track some of these? How difficult is it for a big company, or actually for, economists, but also investors, to see where the supply chain starts and ends?
I really think the game today is around transparency. And transparency isn't necessarily a cure, but it's definitely preventative medicine. Meaning that having that total visibility, as you just mentioned, not only is it hard, but nobody was really asking these questions. We were so focused on leaning out the supply chain and cutting costs and getting just in time in place that we really weren't focused on the total visibility needed, not just for your primary supply chain, but as you mentioned, for your tier 2s, your tier 3 suppliers and beyond. And by having this transparency, you're now able to identify risks and model ahead future problems, which is really where the winnings happen.
So how complex has the world gotten, Jennifer, in terms of supply chains? And did President Trump do us a favor in shifting these supply chains 5 years ago when no one was really expecting it to be beneficial longer term?
Well, I think the shifts have been happening for many, many years. And I think when you look at the pandemic, that forever changed the supply chain, just sheerly pushing us all into our homes. And we're all starting to order hard goods at a pace never experienced before. And the supply chains just couldn't handle it, which we're still trying to dig out from that. Then you have cybersecurity breaches like SolarWinds, or you have the Ukraine situation, or you have the Suez Canal and the ship going sideways. So they're complex, they're hyper-connected. Technology has done this to us, and it's never going back. So this is the new normal, and that's where we go back into mapping the supply chain, monitoring, and then scenario planning and modeling is really what's going to make businesses not have this whack-a-mole approach to and being reactive to problems in their supply chain.
So how many U.S. firms have links to second-tier suppliers in Ukraine right now, Jennifer? And how difficult is it to readjust some of these supply chains? I mean, we're speaking to the chief executive of Unilever, and they were saying that, for example, some of the cooking oil that they use in certain products have had to be replaced with other ones.
Yeah, it's hard because there's only a certain amount of companies that make a certain amount of things in the world. But based on the analysis that we've been able to do at Interos, there's well over 100,000 companies just that are sourcing in their top 1, 2, and 3 tier suppliers from Ukraine right now that they have to look for alternative sources. And that's a massive shift. And you also have to think that if your company is making a shift, your competitors are as well, which is why getting ahead of the problem is so important. I also think, if I could mention, the next thing we're all looking at is China, the situation with Shanghai and Beijing. And if we had over 100,000 firms for Ukraine, Russia, we've modeled over 300,000 firms that have connections into that part of the world. That's a real situation, and that's across retail, machinery, and automotive.
But Jennifer, given the animosity of the Trump administration with China, did a lot of these supply chains not change? So are we, I guess, less reliant on some of these Chinese suppliers than we were 4 years ago?
So the supply chain isn't a political situation. It's really just where are those products and those skill sets available for me to get what I need to get onto the store shelves. And so for all the reasons that we all know, China actually took a forward step in investing in technology, made it very attractive for companies to go and manufacture over there, and then actually had skilled workers and laborers to produce the product. So that's where the supply chain was. And you're now seeing, based on sanctions in Russia and based on the concerns in China, you're now seeing a lot of countries mapping their supply chain and trying to figure out how to unhook and find other parts of the world where those raw materials and skill sets exist.
Yeah, I mean, if you have tariffs, though, that were put in place on Chinese products coming into the U.S., I imagine that would have focused the minds of certain investors in getting away their supply chains from China. First of all, Jennifer, do you have first mover's advantage then if you find some of these supply chain, quirks or the fact that it's not going in the right direction in certain cases? And if you change supply chains, is it automatically inflationary? Because if you bring them back home, it's going to be more expensive.
So a couple great questions there. I do think that the first mover's advantage, the companies that are investing in the transparency and the mapping of the supply chains are absolutely going to win for no other reason that they will actually have the product they need in consumers' hands faster. Not only that, but they'll actually be able to invest and choose how much they're willing to pay for it, which keeps the costs down when the consumer does go to the store. So I do think first mover's advantage, investing in technology, mapping the supply chain is really going to win the day. As far as bringing things home, I do think there's only a certain amount of places in the world that there's skilled workers, there's raw materials, and the supply chain lines up, and that's just the situation.
All right, Jennifer, thank you so much. Jennifer Bisceglie there, the Chief Executive Officer and Founder of Interos, talking about supply chains, of course, China and Ukraine. Now, we're just getting some breaking news out of Russia. Russia Eurobond funds, we understand, has been processed by at least one clearinghouse. Now, from earlier today, we had been briefed by our reporters that Russia had just over a day to get some of these payments on 2 foreign bonds to investors and dodge a default in a closely watched struggle with sanctions. So for the moment, we understand that they have been processed by at least one clearinghouse. We'll have plenty more, of course, on Russia being able to avoid a default potentially for another day. The clearinghouses are charged with then distributing the cash to investors' accounts. So they're kind of the oil in the mechanism. It could mean that the money will get into the accounts that they need to reach. Coming up, protesters rush to the U.S. Supreme Court after political reports that the court is set to overturn abortion rights. We'll get the latest on that shortly. This is Bloomberg.
Wednesday, a Bloomberg exclusive. JPMorgan Chase Chairman and CEO Jamie Dimon speaks with Bloomberg's Francine Lacqua, live from the JPMorgan CEO Summit in London, only on Bloomberg TV and radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, political reports the U.S. Supreme Court is poised to strike down the landmark Roe versus Wade decision, which protects women's rights to abortion. Political says it's seen a draft opinion written by Justice Samuel Alito, which has preliminary support from 4 other Republican-appointed justices. The 9-member court is scheduled to rule in the case by July. Let's get more now with our reporter, Bruce Einhorn. Bruce, first of all, this is an earthquake when it comes to civil society. How divisive will this be in the U.S.?
Well, abortion, of course, is one of the most hot-button issues in the U.S. in culture wars. There is strong support in the U.S. polls show for abortion rights. So a majority of Americans do not want to see Roe v. Wade overturned. That said, the base of the Republican Party is very supportive of getting rid of abortion rights. So this will likely just intensify the culture wars that we already have raging in the U.S.
So, Bruce, what does this mean for the midterm elections?
Well, we already know that Republican voters were extremely motivated to vote in the midterms. Typically, that's what happens. The out of power party typically does very well in midterms. The key thing that could happen here is that suddenly now there are going to be a lot of Democratic voters potentially who are very concerned about abortion rights, who will be motivated to vote, who might not have been in the past. So this does have the potential to really make the Democrats suddenly more competitive in midterms that otherwise were looking pretty down for them.
Bruce, why was this leaked? It feels like it's very unusual to actually get a leak in this kind of decision.
Yeah, it's extraordinary to have a leak like this. It just does not happen. The Supreme Court just doesn't leak. And we should be clear that we don't have any verification that this is authentic or not. So we have to go with what Politico is reporting. That said, though, it does seem to be genuine. And if it is something that we just haven't seen in decades, if ever, really, to have a full opinion, draft opinion leaks like this.
Bruce, thank you so much, as always, for giving us up to date or bringing us up to date with this huge story. Bruce Einhorn. Now let's get straight to your Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. BP has boosted share buybacks by $2.5 billion as cash flow surged, offsetting some of the discomfort from a $25.5 billion charge linked to its planned exit from Russia. The London-based oil major comfortably beat analysts' expectations after what it says was an exceptional 3 months for its trading business. First quarter adjusted net income came in at $6.25 billion, more than double the amount a year earlier.
We've got lowish stocks around the world. We've got lowish spare capacity around the world. And we have a lot of uncertainty in the market, quite frankly, whether it's with Iran, whether it's with Libya, whether it's with the global economy, whether it's with zero COVID in China, lots of uncertainty. But I think if you step back from it, you'd say all of these things lead to a lot of volatility, and we can expect that volatility to continue.
BNP Paribas has reported a surge in both equities and fixed income trading. France's biggest bank joined peers in benefiting from market gyrations amid energy price spikes and Russia's invasion of Ukraine. Markets revenue jumped 53% to 2.8 billion euros, well ahead of estimates. A brief bout of concern regarding Alibaba's co-founder Jack Ma triggered wild swings in shares of the e-commerce company earlier today. Alibaba plunged as much as 9.4% in Hong Kong after state broadcaster CCTV reported authorities had imposed curbs on an individual surnamed Ma in the company's hometown. The stock rebounded after police indicated the accused person's name was 3 characters. Jack Ma's Chinese name is the 2-character Ma Yun. Citigroup is in active dialogue with potential buyers of its consumer and commercial banking operations in Russia. CEO Jane Fraser also said the financial sanctions on many of Russia's largest banks could thwart Citigroup's efforts to exit its operations in the country. That's the Bloomberg Business Flash. Francine.
Laura, thanks so much. Coming up, we speak to the improbable Chief Executive Officer, Herman Narula, shortly. We talk about the metaverse. And of course, we talk about how you dive into it. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, on Saturday, sale of virtual land in the metaverse Other Side raised about $320 million worth of cryptocurrency in the largest offering of its kind. Demand was so strong that activity related to the event caused ripple effects across the entire Ethereum blockchain, disrupting activity and sending transaction fees soaring. Well, we're now joined by Herman Narula. He's Chief Executive Officer and co-founder of Improbable. It's a British metaverse technology company that had partnered with Yuga Labs, the creators of the board Ape Yacht Club, to develop its metaverse offering. Herman, thank you so much for joining us. I have a lot of questions in terms of what kind of technology we need, when do we see the metaverse, and if there's a first mover's advantage, right now to try and get into the metaverse. So first of all, if I'm a big company, let's say I'm an imaginary big drinks company, what do I do to make sure that I don't miss out?
So I think it's worth starting with what's the opportunity for a company like that. And for me, it's really simple. The metaverse is about engaging thousands, even millions of people in interactive activities that enhance their sense of connection to each other and to whatever activity you're promoting. So a great example of where the metaverse is going to be incredibly important is sport. Yes. If we can start to put stadiums full of thousands of fans around the world into virtual spaces, it's just going to grow the engagement of sport.
And Herman, you're doing that technology, right? To be able to basically have around 10,000 people online at the same time.
Yeah, it's actually about 15,000 people now. Yeah, and not just online at the same time, but uniquely, our technology allows those people to be in the same spot. So if you want to get a sense of what that means, the megahertz of the metaverse, kind of like the technical power needed to make it run, is a metric called messages per second or operations per second. So a game like Fortnite does about 10,000 operations a second. WhatsApp does about 1 million messages globally. But to do what we do, you need to do about 1 billion operations a second.
So Herman, so basically Fortnite, because you can only be about 100 players at the same time, right?
Exactly.
So you have to, so what kind of technology is it? Do you have the technology, or is it still something that you need to make it happen?
We've actually developed and production tested this now with events involving thousands of people all over the last year. So what we've had to do is build an operating system that can handle thousands of different players all connecting to the same system and managing all of the communication between them. That's kind of the challenge.
Does regulation come in?
At a certain stage it will, because we see a lot of digital assets becoming a big part of the metaverse, right? And so when people are engaging with things that are financial assets, I think at a certain stage, it's going to be important that regulation comes in.
But Herman, so is it your technology that you'll be able to use, or do you think you'll have to share it with other players?
So what we've chosen to do is actually build an independently governed network called M², which takes our technology and actually connects together the worlds of different companies and allows them to work together. And we've taken quite a different view on that, which is we eventually would like that to be controlled not just by us, but actually by the users.
I was looking at some of the revenue opportunities, and various analysts say it's about $800 billion by 2024. 2024 is around the corner. Who's gaining the most right now?
I think a lot of people are going in the wrong direction with it. They're looking at it as an extension of gaming. I think the most exciting stuff happening is when you combine crypto with the metaverse. So obviously, as our partners, I believe strongly in Yuga Labs and their project with Other Side. But I do think there are other great projects out there too.
But so what does that look like? And actually, how quickly will that be adopted in your eyes? Like if you map out the timeline of how you see this developing.
I think 2024 is a bit too fast to imagine an $800 billion opportunity, but I do see a fast timeline. I think what we're lacking right now are experiences that ordinary people can use immediately and that give them the chance to have something they couldn't have in a normal video game or a normal experience. And that's what I hope we're bringing to the table.
You're also a newly minted author, almost an author, right?
Yeah.
'Cause you're writing a book on why we need the metaverse. What do people misunderstand about the metaverse?
I think people misunderstand that it's about technology. Our society is already full of living ideas. Culture, sport, history, religion, music. These are all ideas that enrich our everyday lives. And my argument is that the metaverse is just an extension of that. It's just taking those things, infusing them with technology, and giving us the chance to have a greater participation in that cultural world.
Do people and companies that don't think about the metaverse now, do you think they'll be left out of it? Is there definitely a first mover's advantage?
I think it's worse than that. I think it's almost a cull of businesses that think of their customers as consumers versus businesses that understand that their customers are going to become interactive participants in a world that they create. And I think the companies that don't get that are just going to be drowned by the ones that do.
But Herman, is this a little bit like, when there was a shift to mobile?
Exactly.
It's going to be an even bigger earthquake for the companies
I think it's
don't
more like
adopt it.
it's more like the internet. It's that fundamental. Yeah. It's an entirely new medium in which people have to develop new business models, new ways of engaging users, new ways of understanding what they want.
But on the internet, at some point, everyone's on it or otherwise, or I don't know how much time a big company or a small company actually has to get on board with this before they fail.
Yeah, I think you have to be working on this problem right now. I can't imagine a large business, especially a consumer-facing business, shouldn't be making preparations today on how they're going to engage audiences in the metaverse, who they're going to partner with, what they're going to do to support a digital asset economy. And it applies even to things like sports. Some leagues are ahead of others, right, in getting crypto and metaverses involved.
I mean, what's the craziest conversation you've had with, like, I don't know, a boomer owner of a company that says, well, the meta what?
There are some pretty wild ones, but I'm surprised at how progressive people are, to be honest. Mostly what I'm encountering in boardrooms is fear. It's not a sense that, oh, this isn't for me. It's more, oh, God, am I going to miss out? Because I think companies have been through the cycle of social media, really wrecking that, their ownership over the user, changing new business models, and I think people don't want to miss out again.
And this is true for European founders, or is there, more of an early adoption in the US because there have seen more disruption?
Yeah, there's a bit more There's a bit more of a forward-looking mindset, I think, in the US companies we've spoken with. There's probably a lot more US business coming our way than European at the moment.
Great. And your book is out in October?
Couple months, October, yeah.
World exclusive, right?
Oh, absolutely.
Right here, of course. Herman Narula, thank you so much, Chief Executive Officer and co-founder of Improbable. Now, this is the picture for the markets. A lot of the focus, of course, that 3% 10-year yield that we touched in the early hours of today. Look out for that. We also have quite a lot of earnings news. Russia poised to dodge default. This was the big story that we broke about 15, 20 minutes ago. Russia's closely watched dollar payments on 2 bonds, moving ever closer to creditors as the country is still racing to unblock the transfers and avoid a default. So Bloomberg Surveillance early edition continues in the next hour. Kriti Gupta, Kailey Leinz in New York, or Anna Edwards here in London. The focus will firmly be on treasuries, the picture also on what we're seeing with bonds. Bond rout deepening, bonds in fact plummeting around the world. Investors bracing for the biggest U.S. rate hike since 2000. Yes, tomorrow's Fed day. Today's the first Fed day, but tomorrow we found out what they did, and it's a wave of policy tightening by other central banks that will maybe push it to go further. This is Bloomberg.
Risk on, risk off doesn't exist anymore now. It is risk on, and lately risk off, risk off.
It has been a brutal market. Certainly April and the start of the whole year so far has been brutal. But it is an important reset. We are in a different environment. Interest rates are going to be rising.
I think right now, front and center for them is taming inflation.
We are better off running the economy with a slightly higher risk of inflation.
Everything that you believe prior to 2008 no longer exists.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, May the 3rd. Our top stories today. A report says the U.S. Supreme Court is set to overturn the landmark Roe versus Wade decision, which has protected the constitutional right to an abortion in America. That could reshape the battle for control of Congress this fall. Bonds plummet as investors brace for the biggest U.S. rate hike in more than 2 decades. Billionaire Ken Griffin says the Fed needs to keep inflation at 4% this year to avoid a recession. And Citigroup takes the blame for the flash crash. The bank says one of its traders made a mistake while inputting a transaction that roiled European stocks yesterday. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta over in New York. Matt Miller is off today, and it is a central bank heavy for us to focus on this week. Kailey.
Yeah, it absolutely is. And of course, this week also a little bit lighter in terms of trading in Asian equities because you still have holidays in places like China and Japan closed today as well. Hong Kong was open for trading, though, and one individual stock in particular was really in focus. That would be Alibaba. You had CCTV, China's state broadcaster, reporting overnight that authorities in Alibaba's home base of Hangzhou had imposed curbs on an individual whose surname was Ma. Investors got really worried that that was Jack Ma, the co-founder of Alibaba. As a result, sent the shares down as much as 9.4% intraday, at one point erasing $26 billion in market value. Then police from Hangzhou said that the individual's surname had 3 Chinese characters, unlike Jack Ma that just has 2 Chinese characters, so then erased a lot of those losses, only ended the day down about 1.8%. But it really just underscores how worried investors are in China about any kind of regulatory crackdown within the tech sector. And of course, investors also worried about that persistent COVID-0 policy, which we continue to monitor. Beijing now halting in-person dining in restaurants until the end of the May Day holiday. At least that, of course, ends tomorrow. You're seeing a persistently weaker Chinese yuan at 668 or so, at the weakest against the U.S. dollar going back to November of 2020. But elsewhere in FX, the big outperformer on the day, that would be the Aussie dollar, stronger by about 7/10 to around 71 cents on the dollar or so after the RBA delivered a larger than expected rate hike, 25 basis points. Economists were only expecting 15 basis points. Really underscores an aggressive central bank, not just in Australia, but really around the world, push to rein in inflation. And also as a result of that, in addition to the stronger Aussie, huge move in the short end in Australia, up 20 basis points on the 2-year, 2.755% is where we sit. Kriti, that is the highest going all the way back to 2014.
Yeah, well, Kailey, a little bit of a risk-off mood here in the United States, or I should say risk-on, but really just marginal. The concern is that it will turn risk-off. After all, tomorrow we are waiting for the FOMC, so a lot of the markets here, a lot of investors going to be in wait-and-see mode. And traditionally, if you look historically, the day before any FOMC meetings tends to be a risk-off day, and we're already kind of seeing perhaps hints of that in the cross-asset picture. Futures about flat right now. The 10-year yield also flat, so once again, not a ton of movement, even as pre-market trading does kick off. A little bit of a negative tone in the crude picture, really ongoing from that China story Kailey was just talking about, down about 0.9%. But once again, in a volatility context, that is still not a huge move to the downside. Let's see, though, if it worsens. Even Bitcoin, a marginal move upwards, 0.5%. Whether it can sustain into regular trading, Anna, that is the question.
Yeah, that's one of the questions, Kriti. We have here in Europe a fairly mixed session taking place, but overall the sense is that we go a little bit higher here this morning here in Europe. European stocks in particular to the south of the continent doing pretty well, up by more than 1%. London is an outlier to the downside, moving lower, I should say, but you know that's because we were closed here in London yesterday. So a little bit of catch up on those losses made by other European markets yesterday. That's why London is under par, if you like, down by 0.3%. One sector that's doing pretty well is the energy sector, and not because of higher oil prices. Kriti was just talking us through there the latest on WTI, and we see that actually moving a little bit lower today. But these are the energy stocks, and energy stocks up by 2.6%. BP is one of those, up by just over 3%. The numbers beat estimates. This for the quarterly earnings picture coming out, and by some margin. It seems that the trading environment, the volatility created by recent geopolitical developments, of course, creating opportunities to make money for trading around oil and energy products, and that is a part of the business that has delivered for BP. They're able to reward shareholders with a buyback that also goes down well with investors, of course, and offsets some of the concern around the charge they had to take, more than $25 billion related to their stake in Rosneft over in Russia. Covestro, this is a chemicals business. They've downgraded their guidance, not because of war in Ukraine, though. This is to do with lockdowns in China, and that has some spooks in the chemicals space as a result of that particular downgrade, down by just over 6% as a result. And I put it in the 10-year German bond because we have been watching this this flirt with the 1% level. It pushed above 1% earlier on. We saw the UK 10-year gilt yield go above 2%. So that broad picture of yields going higher, the sell-off in bonds continuing as we approach the Fed meeting and other key central bank meetings this week. As Kailey said, we've heard already from the RBA this week. Let's move on to Russian assets. The big focus on the ruble, of course, is still around. Can we have more detail, please? European Commission on what exactly is and is not expected from European corporates so that they stay the right line of the right side of the sanctions rules. That's the plea from European businesses we often hear. And in terms of the debt market, a real focus on what is going on with Russia's debts that they previously paid in rubles. There was a grace period that extends to tomorrow, and will we see those coupons materialize in dollars? Bloomberg now reporting that Russia's bond payments are being processed by at least one international clearinghouse. So, Kailey, does it look as if Russia will avoid the first international default on its debt in more than a century?
Yeah, really down to the wire on that one, Anna. Now, as we continue to watch what's going on with Russia's debt payments, let's talk about what else we will be watching today. Pfizer will be reporting its earnings results at 6:45 a.m. New York time. Then we'll get earnings results from Lyft as well as Starbucks after the market close. Plus, the Eurogroup will be meeting via video conference to discuss a draft work plan on the banking union. Creedy.
Well, Kailey, from Europe over to Washington, there's a report that the U.S. Supreme Court is poised to overturn the landmark Roe versus Wade decision protecting the constitutional right to abortion. Politico says it obtained a draft majority opinion being circulated inside the court. Joe Matthew, Bloomberg's Washington correspondent, joins us now in D.C. Joe, a potentially historic moment. What do we know?
Yeah, this is a seismic development here in Washington. As you could just see, about 1,000 people gathered immediately in front of the Supreme Court when this headline broke. It will have a seismic effect nationally as well, as people likely wake up to this news. It came out pretty late last night, but indeed a draft opinion here. It is not a ruling. Justices can still change their votes. We do expect a ruling by July. Could come in weeks, likely a couple of months. And if Republican-appointed justices stand by their positions here, it would effectively ban abortion in half the country, 26 states. Essentially what Justice Alito is writing here is that Roe was flawed in its concept because states, he says, hold the authority to regulate or prohibit abortion. He writes, we now, quote, return that authority to the people and their elected representatives, unquote. Creedy?
All right, Joe. Well, as you said, the court has not yet ruled. If it does so, can that actually be a galvanizing force for the Democrats in the midterms? What are the implications?
Oh, absolutely. This is a game changer on the electoral map. If you look at some of the comments that we heard from Democrats and Republicans last evening, you can see where the lines are drawn here. And it's really something to think that we've got a war going on in Ukraine right now. We have historic inflation, so many different cross currents and issues that are driving the conversation here. But it is looking more and more likely that these elections could be decided based on the culture wars. If you consider the DeSantis versus Disney story that's happening in Florida, the conversations about abortion rights that are taking place around the country, trans rights, gender identity, these are suddenly now the stories and the issues that are driving the debate, as opposed to policy here in Washington that brings us back to inflation, the number one issue, jobs, recovering from COVID, and the war in Ukraine.
Joe, thank you very much. Bloomberg's Joe Matthew with those important developments in Washington. You can listen to Joe every weekday on his radio program Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Now, the European Union is looking to Africa to help replace imports of some Russian natural gas. A draft EU document seen by Bloomberg News says countries including Nigeria, Senegal and Angola offer largely untapped potential for liquefied natural gas. Maria Tadeo, Bloomberg European correspondent, joins us now from Brussels. And Maria, as the conversations go on about when and if we'll see an oil embargo on Russian oil, the gas conversation focuses on Africa.
Yeah, Anna, and we know that the European Union has said it wants to cut down its reliance on Russia by 2/3 this year. So that means they need to find new providers, and they believe that some of the Western African countries could actually fill that void. A lot of this, of course, will depend on the infrastructure, will depend on future contracts, and we know that gas, unlike oil, is difficult when it comes to the transportation. It needs a lot of infrastructure that comes with it, particularly with the pipelines. But it does show that the European Union is taken this seriously when it comes to unplugging from Russia. And Anna, I would point to a figure that came out on Sunday from the German government. They say that their reliance on Russian gas has gone down from 55% before the war to now 35%. The other big issue now moving to oil is this new package of sanctions, which could come in the next few days. A proposal to go for a light embargo, this gradual phase out from now until the end of the year. The Germans, by the way, they say they're now on board with this. And of course, a lot of this in anticipation to that mid-May deadline that would see potentially a big spat between the Europeans and the Russians over whether or not this gas is going to be paid in rubles or not, which European authorities say they should not pay in rubles. Any European company, as that would be in breach of sanctions.
Maria, thanks very much for the update. Bloomberg's Maria Tadeo keeping across the energy news flow surrounding Brussels. Now, Citadel founder Ken Griffin says the Fed will be able to ease off monetary tightening if inflation drops to 4% by year end. He spoke at the Milken Global Conference yesterday.
If the inflation is transitory, if we are heading towards a 4% rate by the end of the year, he has a lot more room to maneuver rates in 2023. If inflation doesn't break soon here, he's going to have to hit the brakes pretty hard. That will put us into a recession.
Joining us now, Bloomberg Markets editor Christine Aquino. And Christine, really interesting that the focus there on inflation, how quickly it will come down, how long it will stay down, and how low it will get to, I suppose. Crucial for Ken Griffin's view of the world. We approach a Fed meeting where we might get some insight.
Absolutely, Anna. And I think what's going to be important for this meeting is not just confirmation of that 50 basis point rate hike that Jay Powell and his colleagues have repeatedly alluded to, but also the forward guidance on what the path is going to look like moving forward. We know that markets are still pricing for multiple 50 basis point rate hikes over the next couple of months beyond May. And so it'll be really valuable to get that insight from Jay Powell to see whether the Fed is planning to continue on that path, whether they're going to validate market pricing for it, or if they're actually going to signal some signs of potential easing off, as Ken Griffin says, if there's potential for inflation to back down by the end of the year.
Bloomberg's Francine Lacqua, thank you as always. We, of course, will all have our eyes on tomorrow's FOMC meeting. Let's stick with the markets, though, and go to Citigroup, saying its London trading desk was behind Monday's flash crash in Europe. Shares across the continent tumbled after a sudden 8% decline in Swedish stocks. Let's get more with Bloomberg's Tom Metcalf. Tom, walk us through what we know from Citigroup.
Yeah, so it looks like a classic fat finger crash. It appears they effectively input the transaction data incorrectly. So, a simple, almost clerical error, but it's had very huge ramifications for a very short period of time. I think the Swedish stock market dropped by something like 8%. So what we're looking at now, that was fixed, the market's kind of recovered. But what does this mean for Citigroup? Are they on the hook for any of those losses? Might they be facing lawsuits at some point in the future? Or are they kind of able to just sort of box this off and say, oh, our bad, let's all move on?
Yeah, well, a big bad at that for sure. Tom, you said fat finger, and I just instinctively took my hands off my keyboard. Thank you so much to Bloomberg's Tom Metcalf. Now let's get back to the U.S. markets and take a look at some stocks that are moving in pre-market trading. There's one in particular I want to mention in the news this morning, and that would be Stellantis. Reportedly, the company is buying the car sharing joint venture from BMW and Mercedes, so that may give it some new revenue streams. That stock is up about 1%. Another stock that is moving higher, this one on the back of earnings, is SolarEdge. Of course, a solar company really benefiting from higher demand. It saw revenue up 62% in the first quarter, and its second quarter outlook beat expectations, so that stock up about 3.4%. One stock moving lower on the back of earnings, though, is Mosaic. Of course, this one's interesting because it's a fertilizer company. We know fertilizer prices have gone up in a big way, yet it missed on both the top and bottom line. That stock is down about 2.25% before the bell, Anna.
You started there talking about car sharing, Kailey. I used to do that for a long time. Other people, though, it seems, are pretty untidy. One of the difficulties with that model. Coming up on this programme, we will talk about fixed income markets. Really fascinating day for that conversation. Iain Stealey, International Chief Investment Officer for Fixed Income at JPMorgan Asset Management, joins us as we talk about the 10-year going over 3%. It did that a few hours ago. We will talk about how sustainable that kind of move is. Bloomberg is live from the Milken Conference in Los Angeles. We'll have interviews throughout the day, including Sheila Patel, Patel of B Capital and Christopher Ailman of Calstras. Lots to talk about then at that Milken conference. Plus, don't miss Bloomberg Crypto. It is Tuesday. It's the day for it. Today at 1 p.m. New York time, 6 p.m. in London. Today, the team will be hearing from Adam Back, CEO of Blockstream, and also investor Harry Yee of the Quantum FinTech Group. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. One of the big questions, the ultimate battle between the bulls and the bears when it comes to the stock market. We've seen this pretty huge sell-off year to date, but the question is, what is the case? The bull case here being you've sold off so much, valuations now back down to pre-pandemic levels. Therefore, you should naturally see a bounce back. The bears saying, well, yeah, it's back down to pre-pandemic levels, really going back to what you're seeing early of 2020, January 2020, early or late 2019. But even then, we were having the same conversations, extreme valuations, a prolonged rally thanks to the Federal Reserve support, even this idea of some of the growth slowdowns, the growth worries that we're dealing with now. Well, that was an issue about 2 years ago as well. How much of it comes down to what the FOMC is going to say tomorrow? Ksenia Galushka, Bloomberg Equities editor, joins us now. Ksenia, thank you as always for joining us. Let's get right down to it. How much of this decision, whether or not the bulls or the bears win, is based on what we hear from Chairman Powell tomorrow?
Yeah, tomorrow's meeting is going to be key. Obviously, the market has already priced in a rate hike, but what will be key is the expectations for further rate increases, because the market has been obviously very scared. We've seen stocks collapse in April. For the S&P 500, it was the worst month since 2020 pandemic starts. So the market has, for the most part, it seems, priced in the fears of a much more aggressive tightening in the Fed's policy. But let's see what happens tomorrow, because there might be further losses, or on the contrary, we might see buying in the dip as the valuations are getting more attractive with every day.
Yeah, interesting, Ksenia. And I read some research recently, Bloomberg summarizing some research. I mean, you've got JPMorgan on one side saying maybe there's some upside room here. Morgan Stanley on the other side saying, no, we need to be selling the S&P from here. But then there was some interesting research suggesting that the buy the dip mentality has gone. So if you're looking for the upside, you wonder where that comes from.
It is a very interesting debate, and it does come down to the outlook on the U.S. economy. So the bulls say that, no, we're nowhere near a recession, and the growth can continue, although at a more tepid pace. And then bears are saying, no, all the signs are flashing that the recession is approaching, and earnings growth is not that strong. So it'll be very interesting to see who actually wins. Now, the earnings season has been actually surprisingly robust, and the main reason for that is that analysts were brave enough and fast enough to cut the expectations early in the year, and that's why earnings have been coming in strongly. So that's one of the reasons why stocks might have more upside going forward. Another thing is positioning. There's been massive outflows out of US and European equity funds in the past few weeks, and usually that is a contrarian sign that there might be upside from here, just because the positioning is so bearish.
Yeah, April has been uncharacteristically tough, hasn't it, for some of these markets? Ksenia, thank you very much. Ksenia Galushka with us to talk stocks. And for more market analysis, check out MLIV Go on your terminal. That is the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. President Biden's top trade negotiator signaled that relief from U.S. tariffs on China could be one way to confront inflation. U.S. Trade Representative Katherine Tai said the tariffs should be examined as part of a look at broader economic policy. As soon as this weekend, Tai's office may begin a review of the first group of tariffs on more than $300 billion in Chinese imports. Amazon workers at a facility in New York voted not to join an upstart union. That happened only weeks after the union won a resounding victory at a warehouse across the street. The election at a sorting center in Staten Island was not close. The Amazon labor union lost 618 to 380. Bloomberg has learned that German prosecutors have raided the offices of Morgan Stanley in Frankfurt. It's part of the investigation into the controversial CumEx trades. CumEx was a trading strategy that siphoned off at least $10.5 billion in government revenue by taking advantage of German tax laws. And the Bank of England is expected this week to raise interest rates to their highest level in 13 years. It may also clarify how it plans to sell off some of its $1.1 trillion in government bond holdings. That would take the UK's central bank into uncharted territory. None of its major economy peers have yet sold government bonds accumulated under quantitative easing since 2008. And Anna, my question for the BOE as well as the Fed tomorrow is how much room is there for a hawkish surprise, considering that Australia was able to deliver one overnight?
Yeah, it's an interesting one, although the Bank of England, of course, ahead of some other central banks in terms of the amount of interest rate hiking we've already seen, and the conversation turning into whether we are witnessing a central bank hiking into weakness. That's certainly part of the conversation here in the UK. We will maybe talk about that, but certainly about the Fed and what we're seeing in Treasury markets right now with Iain Stealey, International Chief Investment Officer for Fixed Income at JPMorgan Asset Management. He joins us shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. A report says the US Supreme Court is set to overturn the landmark Roe versus Wade decision, which has protected the constitutional right to an abortion in America. That could reshape the battle for control of Congress this fall. In markets, bonds plummet as investors brace for the biggest US rate hike in more than 2 decades. The Federal Reserve begins its 2-day meeting today. Billionaire Ken Griffin tells Bloomberg the Fed needs to keep inflation at 4% this year to avoid a recession. And Citigroup says its London trading desk was behind Monday's flash crash in Europe. Shares across the continent tumbled after a sudden 8% decline in Swedish stocks. Citi says one of its traders made an error when inputting a transaction. I'm Anna Edwards in London with Kailey Leinz and Chrissy Gupta in New York. Matt Miller is off today. And Chrissy, a lot of the focus, of course, this week on central banks. The Fed looms very large.
Yeah, the coin toss essentially between the bulls and the bears is all going to be on the FOMC meeting. And of course, that we are expecting that tomorrow. And a lot of it is simply going to be what you're going to see in markets today. Remember, traditionally, the day before the FOMC meeting decision, you do start to see a risk-off tone already. In just 30 minutes, we're already seeing that. A marginal gain to start off our show. Now you're seeing a little bit of a negative tilt. And you can really see that cross-asset. No movement on the 10-year yield. Really a wait-and-see kind of approach in the bond market. A similar story in the crude market, down 0.8%. Those growth concerns in China still kind of pressuring the crude market, making that spiral continue. And even Bitcoin losing a little bit of that momentum it had earlier, now up only 0.5%, Kaylee.
All right, Crudy, well, there's not all that much action in pre-market trading as well, but something I did notice is you're getting a lift really across a lot of the travel complex, including the cruise lines. Carnival out last night after the bell saying that it is the first U.S. cruise operator to restart its entire fleet after, of course, the shutdowns of the pandemic. Carnival is up about 1.4%. You're seeing a bit of a read-through into Norwegian Cruise Lines as well. It's up about 0.9. Also a little bit of a lift for some of the airlines, Anna. United is up about 0.6%. American only by about 0.25% or so. You got a lot of travel-related earnings out after the bell yesterday, the likes of Avis, which beat Expedia as well. They're not trading yet, though, in early hours, Anna.
Yeah, certainly plenty of demand for travel here in Europe. That's a real big focus for that sector. Let us have a look at where we are in Europe then. And the European equity market picture looks fairly positive, up around 0.5%. That hides some divergence. Some of the southern markets doing really quite well today. The London market underperforms, but obviously that's a catch-up story because London was closed yesterday. One of the sectors doing really well is the energy space, but that's not to do with higher energy prices. As Kriti was pointing out, actually we've seen those coming down just a little bit in the most recent session. But BP is one of the reasons behind this. The trading business at this big giant within the energy space doing really well and helping the business to really outperform or perform very well versus expectations. And that is something that the shares have paid attention to. Also a return of cash to shareholders, offsetting some of the concerns around the write-down that they had to take in relation to their Rosneft stake. Covestro, this is a more worrying sign. If you're looking at what's going on in China and you're thinking about how that spills through into global businesses, Covestro is a German chemicals business, downgraded downgrading their guidance today, but not because of war in Ukraine. This is to do with lockdowns and other measures that are slowing the Chinese economy. The 10-year German Bund yield, I put that in because, as Kriti showed you, the 10-year US yield, that's been flirting with 3%. We've been flirting with 1% on the 10-year German bonds. We remember when we were talking about negative rates a lot here in Europe. Well, not anymore, it would seem. Talking about 1% here, 2% here in the UK. Let's move on and show you Russian assets. A lot of questions still around the ruble payment scheme that the Kremlin wants to introduce for Russian energy assets. That's rumbling on. We're also seeing a lot of news flow surrounding the payments that Russia made on its sovereign debt, the international dollar payments. And it seems that they've been waiting until the end of this grace period. The grace period comes to an end tomorrow. We've all been waiting to find out whether that money would find its way to its end destination. And we have been reporting here at Bloomberg that at least one international clearing bank has received, or clearing house has received that payment. So will they avert that non-payment there, that default, Kailey?
Yeah, will those dollars end up where they need to be? That really is still the question. So we'll continue to follow that this week. But of course, we're also following a slew of central bank decisions. And Santander Executive Chair Ana Botín weighed in on the path ahead for global central banks. Just take a listen.
There will be an increase in rates, and central banks, have a narrow path to go down without harming the economy, but also neutralizing inflation, which is having a negative effect on consumers. But net rates will go up.
It's a tough line to walk. Joining us now is Iain Stealey, JPMorgan Asset Management International CIO for Fixed Income. Iain, let's focus on the Fed first, which of course will be out tomorrow, likely with a 50 basis point hike. In the market anticipation of that, we have a 10-year Treasury yield dancing around 3%, a 2-year at 277 or so. Is there value in Treasuries at these levels?
I think it's quite difficult to say there's actual value, given that we are at the very beginning of the rate hiking cycle. And if you look back to where we were in 2018, when inflation was nowhere near the level it is at the moment, we got up to 3.25%. So I don't see why we wouldn't be able to go through that through the second half of this year. So for us at the moment, it's a case of still remaining short treasuries and looking at other parts of the fixed income market to try to generate returns.
Iain, what are you going to be looking for specifically from the Fed this week? There's been a lot of focus on, of course, the size of the hike and how many from here we will see, how many outsized hikes we will see, what the path into the second half of the year will be. What are you looking for?
So I think what we're going to be looking for is trying to get an indication of where they see the path of rates. So we could get a surprise. There's no saying we couldn't get a surprise. We possibly could. I think there'll be at least one person voting for 75, so maybe following the RBA and maybe a little bit more hawkish on that front is a possibility. I do think they will go 50, and I think actually what I would be interested over the next few meetings is how many 50s in a row do they get? As you said, Anna, these are outsized hikes compared to what we've been used to or what we've expected through previous cycles. And then I think the bigger question is maybe what stops them doing 50? When do they say, actually, we've done enough 50s and we're now comfortable just going with 25 and going back to normal? What sort of numbers would be needing to see inflation to give that frame of mind for them? So there's a lot of hikes pricing. I think we've got 10 for the remainder of this year across 6 meetings. So at the moment, 4 50s are really expected at some point. It's going to be a case of when do we end that 50 program, I think will be more interesting from my standpoint than what they maybe do this week. So I do think we'll get 50, which is what the market's pricing.
And Iain, do you think we've seen the peak in inflation in the US? And what is the link between when we peak on inflation and when we peak on yields? Talk us through the linkages there.
So the likelihood is, whether it's now or whether it's over the next month or so, we probably have seen the actual peak in inflation. The question then will be is how quickly does it come down? How quickly do we get back to a sense of normality, or at least a sense of what the Federal Reserve is comfortable with? Are they comfortable with 3%? Are they comfortable with 4%? At least maybe over the shorter term. I think it's going to be that which will be more interesting for us is, do we hang around these very elevated levels for the next few months, or do we start to trend back down again? Year over year effects, we should trend down, but I still feel it does feel that inflation's a little bit sticky at the moment, and will we be moving down the pace that the Fed would like to see us moving down?
Iain, can we talk about the China question for a moment? The 10-year Treasury note now yielding more than the Chinese bond equivalent. I'm curious about the consequences of that policy divergence between the U.S., between the Fed, I should say, and the PBOC.
So I think you need to look at it from a couple of different angles, because obviously if yields in the US continue to go higher, you're going to be losing capital on the back of that. So maybe that makes them less attractive, because you've got a Fed that seems to be very committed and rightly so to raising interest rates. Whereas on the flip side, you've got the Chinese authorities who are easing policy at the moment, trying to combat the lockdowns that are going on there. Although the bulk of their easing is coming on the fiscal side rather than actually on the monetary side. So that would make an argument not to own treasuries and possibly looking at China as an alternative. But I guess the flip side, that if you are an overseas investor at the moment, you do get more yield, as you rightly said, on the treasury. It's also very expensive to hedge Chinese rates. So if you actually want to buy the Chinese yield and then hedge it back to your base currencies, you basically give up most of that yield. So there's very limited carry there. So we've seen a huge amount of flow coming out of Chinese government bonds, basically reversing everything that's gone in, or a lot of what's gone in over the last few years since they've been included in indices and since they've had that attractive yield. So I think it's a more active debate at the moment. It does feel like people are actually wanting to own neither at the minute. You don't really want to own Chinese government bonds, but also you don't really want to own treasuries either.
All right, Iain, that's all on the government side. On the corporate side, how much risk are you willing to take in credit, whether quality or duration?
So I would try to remove the duration aspect of credit at the moment, given our view of higher yields. I do think we're getting to levels which are quite interesting, particularly in places like the high yield market, where you've got a spread of north of 4% on the US market, you've got a spread of north of 4.5% on the European market. And if we are right and the economies continue to grow and we expect default rates to remain very low, much lower than trend over the next 12 months or so, we do still see opportunity there. Now, again, there is a bit of a risk-off sentiment. We're seeing stocks underperforming. We're seeing credit spreads widening. But at some point, these spreads become attractive and you do need to look to step in. It has been a bit of a one-way trade this year, people not wanting to own the credit market. I do feel we're getting to levels that are looking, again, a little bit more interesting. Not quite back to where we were in mid-March, where we did see a nice relief rally. But as we approach those levels, I wouldn't be surprised to see some people stepping in.
Iain, thanks so much. Iain Stealey, JPMorgan Asset Management International CIO for Fixed Income. We were just talking with Iain about China and expectations for China. Well, Fitch cutting their Chinese growth estimates for 2022. That forecast being trimmed amid the COVID-19 outbreak, of course, and the measures being taken there, raising 2023 growth, but only by 0.1%. So the focus on that downgrade to 2022 growth. When we come back, we will talk more about that. We are going to be talking to Damien Sassower, who'll be with us to discuss. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Bain Capital co-managing partner John Connaughton. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
It is very hard to move away from China. And we're seeing that Chinese imports to the US have been rising, not falling, despite everything. Why is this? Scale, efficiency, and they're very, very good at a lot of what they've done. I think what the new normal in supply chains is going to look like, it's a 5 to 10 year journey. It's not a 1 year one.
Citigroup CEO Jane Fraser speaking exclusively with Bloomberg yesterday. Let's stick with the China theme. Beijing going to extreme lengths to avoid the coronavirus woes suffered by Shanghai. China's capital has ordered repeat testing of most residents, halted dining in and at restaurants, and barred access to public places without a negative result. And moments ago, Fitch cut China's 2022 growth forecast to 4.3% from 4.8% earlier, but raised the forecast in 2023. To break it all down, Damien Sassower of Bloomberg Intelligence joins us now for more. Damien, this has been an issue for a while now. I'm curious about the effects of not the ripple effects that we've been talking about, the exports, but the effects of China specifically. Can it dig itself out?
I don't think so. No, I'm kidding. Look, the fact of the matter is we got the PMI data yesterday. Demand is weak. I mean, it is very weak. Consumer spending has fallen off a cliff, and it's really infrastructure spending. You have to remember, China would rather stimulate via the fiscal side of the balance sheet, not the monetary side, because as we saw in March, foreign outflows out of China government bonds most in history, basically, because because of the rising rate differentials, which we talk about relative to the U.S. But for me, if you just look underneath the surface of the PMI data, export demand, new orders, construction activity at the worst since the pandemic. So, what that tells me is that even though China would like to stimulate through the infrastructure side, the lockdowns aren't allowing it to do that. And so, you listen to people like Leland Miller talking about maybe a fall in GDP to something on the order of 2% this year. I mean, we're not calling for something like that, but certainly the 5.5% full year 2022 GDP growth target is going to be a hard swath to manage.
Yeah, well, let's go back to the interest rate differentials. We were just talking about this with Iain Stealey. This is a key point because they're trying to stimulate, but how much can they really do that? How effective is that in the face of a hawkish Federal Reserve?
Well, it's interesting. There are certain assets that are priced off spread and certain assets that are priced off yield. And as we've just realized this month, the carry trade fell off a cliff. I mean, Brazil, Chile, all these high-yielding emerging markets, basically, who have large yield differentials relative to the U.S., their currencies got clobbered. Why? Because that reach for yield isn't as important in this environment. It's going to become more of as we transition from inflation fears to growth fears, it becomes a spread game, at least in fixed income, right? It becomes about valuations. It becomes about fundamentals. No one's going to shoot for the moon in high yield. They're going to basically take what the market gives them. And that kind of creates a little bit of it kind of makes these yield differentials not as important in the mind of creditors. But it's certainly something you have to remain mindful of. But if you do shift to the fundamentals, China's not looking very good right now.
Yeah, and I'm looking at a Chinese yuan at its weakest since November of 2020. You would have to think Beijing's going to get uncomfortable with that at some point. I want to pivot, though, to Russia because, of course, the clock is ticking. There is a deadline tomorrow. The grace period will expire for that $650 million worth of coupon and principal payments. We understand, based off of breaking news this morning, that at least one clearinghouse has received and processed those payments. Where do we stand with this? Do you think it is likely that Russia is going to be able to avoid default here since it's tapped its dollar reserves?
Well, let's set it straight this Watergate. I mean, if we're talking about what's going on in Russia, it's the correspondent bank, Bank of New York Mellon, which has actually passed the money through to Citigroup, which is the paying agent. Now, Citigroup needs to get approval from the UK and the US regulators, OFAC, in order to pass those payments on to creditors. That may take time because what Citi has to do is verify that those funds came from a non-sanctioned, non-blocked account, right? Mm-hmm. So for me, even if there is a delay on tomorrow's grace period deadline, I still think they'll have a little bit of wiggle room to get that money to creditors. So you're right. It looks like Russia's going to avoid a default, an external default, their first since 1918. But what's the willingness of Putin, of Russia, to continue down this path, to continue paying? I'm suspect on that. So I'm not saying that a default is inevitable, but I mean, certainly highly likely. What's interesting about those 2022 bonds that they did make the payment on, 25 cents on the dollar prior to it, now trading at 90 cents on the dollar. If you look at Russia 5-year CDS, it was pricing in like a 99.9% probability of default. That's fallen to like 95%. On a 1-year basis, though, the probability of default has fallen from like 98% to 50%. So Russia may manage to avoid default this year, but the verdict is still out, and certainly creditors are waiting to receive their funds.
Okay, that's really interesting. So there's the short term, and then there's the long term, could be different. Damien, that's the specifics around Russia. Back to the broader emerging market story, and what is at stake this week as we hear from the Fed. We talked to Iain Stealey a little bit earlier on, and he was saying his focus is going to be just how long they're going to be keeping hiking at these sort of elevated 50 basis point levels, and what might stop them doing that. I suppose the same thing's on your mind as we look to the Fed from an emerging market perspective.
Absolutely. I mean, and I've been looking for that sort of dovish tilt from the emerging market central banks, and we have Brazil and Chile this week, right? So we're going to get a real sense. I mean, they have been some of the most aggressive central banks in terms of hiking rates in the emerging market complex to date, and we're going to see whether or not they continue to deliver rate hikes on the order of 100 basis points per meeting. The market's expecting that. We'll see if that happens. But if you look at Australia, I mean, they surprised to the upside today. Granted, they're a developed market and they're kind of in a different place in the cycle. But, I do believe, again, Anna, as we transition from inflation to growth fears, it's going to be messy, and it's not going to be linear for all intents and purposes. So I can definitely see some aggressive central bank rate hikes choking growth across the EM complex. And growth is something that it's too short in supply for emerging markets. They're going to start to shift their focus back to that. And we'll see whether or not they can come up with the stimulus necessary to kind of maintain their economic trajectory over the near term.
Damien, thanks very much for your thoughts, as always. Damien Sassower of Bloomberg Intelligence joining us very bright and early in New York. And stay with Bloomberg for our coverage of the Fed decision and news conference. That's tomorrow, starting at 1 p.m. in New York, 6 p.m. in London. This is Bloomberg.
technological change is real, it's fundamental. But that doesn't mean the purchase price doesn't matter, and the entry point doesn't matter. So I think people who have benefited from this extreme low rate, high liquidity environment where all manner of growth have been rewarded, I think that's where the greatest correction will come.
Mark Rowan, co-founder of Apollo Global, speaking yesterday from the Milken Institute Global Conference in Los Angeles. Now joining us is Tom Keene, co-anchor of Bloomberg Surveillance with a bow tie fit for the Met Gala. Tom, the first Monday in May is over. What chart are you looking at on this first Tuesday?
The chart I'm looking at is what Mr. Rowan's looking at. I thought that video was very, very apt to where we are right now, Kailey. It is an adjustment world where yield is the price of money. This is in Europe and the United States. The 10-year yield in blue, the United States yield, the German yield negative, and then up. And this is a really, really instructive chart in that our yield is back to the summer of 2011. The German 10-year yield is back only to the 2014 summer. The German yield's got a long way to go to get back to what seemed normal after the great financial crisis.
Tom, you have a special lineup this morning. Ken Rogoff of Harvard, an exciting lineup.
Yeah, well, Mark Cabana is, frankly, as exciting as Professor Rogoff. Mark Cabana is going to join us at Bank of America, really get his understanding of the new world of 3% yield. And then to have Professor Rogoff with us is a huge deal about our central banks, but really about how free-floating exchanges, foreign exchange, will adapt to what the central banks do. We could talk to them about a million things, but that's front and center today.
All right, looking forward to those conversations. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. Now, we did just have some breaking news crossing the Bloomberg terminal. Some Russian bondholders say that they have indeed received payments in dollars. Remember, that grace period does expire tomorrow for those Russian payments, $650 million worth of coupon and principal payments. So it does look like perhaps Russia will be avoiding a default for now on that debt, as some bondholders say that they have received those payments in U.S. dollars. That is really key. Now, in addition to that, here's what else we are watching today. I will be watching Starbucks earnings after the bell. Remember, this will be the first report since Howard Schultz came back into the job as CEO. Investors are really going to want details around what his plan is after he halted Starbucks' buyback program on the day he came back. Also, China, the color around that could be really interesting here, expecting to see a big hit to same-store sales in that country as they continue to deal with COVID-related shutdowns. Creedy.
Yeah, and Kailey, Starbucks can really sometimes be a proxy for that economic growth, for spending ability for the American consumer. Some other gauges to watch, of course, and what I'll have my eye on at about 10 a.m. are those factory orders. Inventory is really key, but also those JOLTS data, job openings in an extremely tight labor market. What do job openings really look like? Do you start to see some of the steam really let out of that labor market, Anna?
Yeah, interesting to watch the labour market in the US, the labour market tight here in the UK as well. The focus, though, political and in geopolitical, really, today. Prime Minister Boris Johnson is going to be addressing the Ukrainian parliament, we understand. He's going to be channeling Prime Minister Churchill, the wartime leader here in the UK, as he likes to do. This is Ukraine's finest hour, he will say, channeling that famous wartime speech. Zelensky, of course, channeled Churchill when he said we'll be fighting them in the forests, and similar when he addressed the UK parliament. So that is a focus. We'll also focus on the French president, though, Emmanuel Macron. He's going to be speaking to his Russian counterpart by phone. Look out for details of that conversation shortly. That is it for the early edition of Surveillance. Surveillance is ahead. This is Bloomberg.